Hello and welcome, and thank you for joining us here today. My name is Mennie, Head of Managed Portfolios at HUB24. We're really pleased to be presenting you with findings of some research that we've been working on in partnership with global actuarial firm Milliman Group. We believe this research clearly quantifies and highlights features available to advisors on advanced platforms such as HUB24 and how they can provide improvements to investment performance and tax outcomes. I have with me today Wade Matterson, Principal of Milliman Australia's business, who will step us through the process and results from 5 specific case studies, and of course, bring his observations and broad knowledge to the table. Welcome, Wade, and thank you for joining me here today.
Thanks, Brett. It's a pleasure to be here, and it's great to be able to share some of this research we've been doing with HUB24 with a wider audience.
Great, and look, Wade, I've really enjoyed working with both you personally and the Milliman team on this project over the last few months. For our audience though, just wondering if you could just tell us a little bit about the Milliman Group and a bit about how Milliman have been assisting HUB24 with this research specifically.
Yeah, absolutely. So Milliman, for those that may not be too familiar with us as a business, is a global firm of actuaries. So quite often the instant thought that springs to people's minds is, the nerdy guys and girls that are doing a whole bunch of number crunching and playing around with data and doing sort of advanced calculations. And we've been doing that across a whole range of different industries and sectors within the Australian market, particularly within retirement and wealth management for over a decade now. And I guess the reason that this research in particular is particularly exciting to us is we've been very much focused on the outcomes from investing, whether that's through superannuation, retirement, or other applications. And I think what we've seen is a real challenge in the marketplace is, traditionally people think about investing as returns and fees around asset allocation. And really what we've seen in the work that we've been doing with Hub is to actually go beyond that, to look at some of the functionality that exists within platforms such as HUB24 and try and actually quantify using real life data, some of the benefits you can get from being much, much smarter around the way that you invest. And so we're going to talk a lot about looking particularly at, tax adjusted returns, so how you can be smarter around managing tax positions. And I think that's where things like managed accounts are starting to really shine a light on new approaches to investing for advisors and their clients.
Now, I think it's an important point, Wade. It's really the after-tax returns that are extremely important and should be considered. And also, there's a lot of differences between the platforms too. Wade, I might just head straight to the agenda itself. And as the head of managed portfolios at HUB24, what I'm going to do is just briefly talk about the why behind the research, and I'll do this just in a moment. Wade, you and I will then step through 3 core elements of the research and the white paper, namely managed funds versus managed portfolios, and looking at a like-for-like direct comparison under identical switching scenarios. The second piece being tax optimization. So we've got 2 case studies demonstrating the tax method flexibility or choice that's available on HUB24, and also the algorithms that sit behind the platform to enable advisors to do it very, very easily, just at the hit of a button. The third piece is around progressive portfolio implementation, and we're going to demonstrate 2 particular examples of how using advanced technology on the platform is available for portfolio and asset managers on HUB24 to provide flexibility in what I call street smart portfolio implementation. At HUB24, when all 3 of these components are combined to provide additional value, we have termed this in entirety to be Platform Alpha. I'll recap and provide a summary of the findings for you at the end as well. So let's get started with the why at the beginning. So as a market leader in platform technology, HUB has established itself as an innovator. So we have broad choice, we have flexibility, and we have quite exceptional functionality. I guess it all starts from being a true fintech with our roots that have been embedded in managed accounts or managed portfolios specifically. So HUB24 was purpose designed from the ground up based on managed portfolio functionality and administration from its inception in 2007. So this was in anticipation of the growth of managed portfolios, driven by the advancement of technology to enable the delivery of better outcomes at the end of the day for investors. So what HUB24 set out to do with this specific research was to quantify the technology differentiators, to provide very clear examples, real-life examples of where HUB24's functionality can be leveraged by advisors and also portfolio managers to create additional value for clients. And this is why we engaged Milliman to help quantify this for us. So Wade, my first question for you is, what do you think the role that technology is playing today, and how is that enhancing the value of advice, and what trends have you seen evolving specifically over the last couple of years, maybe 3 to 5 years?
Yeah, thanks, Brett. So I think, technology obviously has a massive role to play, particularly when it comes to wealth management now in the Australian marketplace. And I think, as actuaries and people that focus a lot on the numbers, there are a few different reasons for that. But one of the sort of things that really grabbed us as we started working our way through this research, with HUB's assistance, is there's so much more data that's available that really gives opportunity to platforms to start to deliver much more efficient and better outcomes for investors. So, as part of this exercise, we started to kind of work our way through the information that's available. We could actually start to assess and pick real life examples that are really representative of the way that advisors and their clients are using platforms and managed accounts. And so it's really kind of interesting from our perspective, because typically the way you go about it is you would pick, various cameos and you make them up as sort of hypotheticals. And then you try to actually sort of take that work and research and present it, as really an illustrative example. But what we've been able to do here is actually quantify the real life benefit that actual investors and clients on these platforms are experiencing, and use those as the examples we're going to speak to today. And so, it becomes really interesting then, because as you're an advisor and you're starting to look through some of these things, number one, they're going to be quite representative of what most people are seeing. But also in some cases, advisors may have clients that sit either side of these sort of average clients or case studies. And so whilst we'll talk about particular tax benefits, depending on the nature of the clients that you deal with, the tax benefits you may get through some of these examples may actually be much greater. And some of those things which we'll point out are, examples where, switching behavior is higher or turnover is higher. And also, some of the examples we've pointed to or looked at are reflective over the last number of years. But if you take something like the COVID experience, where there was a lot of volatility, then obviously the benefits become greater again, because market conditions will have an impact on the way that clients behave. So it's really exciting for us to get our hands dirty with real actual client data and start to present the benefits of what you actually see people doing in a real life example.
And you've probably raised a good example. COVID-19, a lot of volatility. There tends to have been a lot more switching or changing of assets, to become more defensive. So Wade, let's get started with managed funds versus managed portfolios. As we know, managed funds have dominated the wealth management industry for quite some time. However, more recently, managed portfolios have proven to be very popular with advisors and offer significant flexibility, efficiency, and also value at a time of considerable change that we're going through in the industry. The core differences between managed funds and managed portfolios is their asset ownership structure, being bundled or unbundled, which has a number of implications for investors. With funds or bundled structures, investors buy units that reflect the value of the underlying assets. With portfolios or an unbundled or non-unitized structure, investors have a beneficial ownership in the underlying assets. They're not buying units within that structure. So what are the practical implications of that? Well, firstly, for managed funds, this means that investors may be buying into potentially existing embedded capital gains. That's one issue. The second is that switching requires selling of the units, therefore crystallising a capital gains tax event. And thirdly, when switching, the new fund will often or may contain some of the same underlying assets. So you've sold something that you still effectively want. With managed portfolios, the investors firstly control their own individual tax outcomes because of that beneficial ownership. And secondly, switching may not incur a full capital gains tax event, as not all the underlying assets would be required to be sold, because there'll be a lot of common assets across the two portfolios. So Wade, I'm really keen to hear your view of how you've seen investment products evolve, particularly with managed portfolios over the last 5 and maybe even 10 years. So what have you seen?
Yeah, thanks, Brett. I think it's quite interesting, and obviously, from the time we've been working in the market, which was just before the financial crisis, it's fair to say that in the last decade and longer, there's been quite a lot of structural change that's kind of going through the entire industry. And so the real kind of fascinating thing to us is if you think about how that's impacted the financial advice sector and the clients that they deal with, you've got this, almost sort of pincer movement in some respects. You've got advisors that are obviously under a huge burden from a regulatory kind of impost, and they're trying to service more clients, because demand, as we see people get older, become wealthier, try to navigate the complexities of the system, just to going up and up and up. And so you've got advisors trying to figure out how do they become much more efficient in the way their businesses operate and their business models operate. And so, clearly platforms and the way that they have evolved and changed their functionality is a big part of that, and trying to find ways to help advisors become more efficient. But at the same time, you've got this other challenge, which is advisors seeking to bring more value to the table. And that's really coming from, the kind of underlying dynamics that we're facing from a market perspective. So in this very, low return environment that's got a lot of volatility in it, and so clients are demanding much more from their investments. And so again, it's really exciting to us as we kind of worked our way through here that starting to think about how platforms can help advisors gain an edge in many respects when they're dealing with their clients is going to be increasingly important. And the analogy I often kind of use when I sort of think about technology and its real role that it's playing here is a kind of equivalent of the way we used to find our ways around the streets of Sydney or Melbourne or other cities across the country, where people that are old like you and I kind of remember thumbing through sort of a street directory, and you go back to the index and you find the street and you've got to navigate and turn pages. Hopefully you've got a co-pilot that you've still married to by the end of the journey. But now what we're doing is, we've got things like Google Maps, and Google Maps ultimately is doing exactly the same thing as what the street directory did. It's helping me get from A to B, but what it's doing is using technology to help us do that in a much more efficient way, where it's actually navigating based on real-time data, real-time information. It's seeing where there are traffic jams. It's seeing where there are obstacles in the route from where we started to where we want to get to, and it's just giving us a much better experience. And so I kind of think of that as platforms are the equivalent of that sort of Google Maps analogy, and actually it's not that dissimilar. It's not a bad analogy, because financial planning is helping people get from A to B from a financial perspective. So I often find it kind of resonates quite strongly, and it makes sense that platforms are now stepping into that breach to help make that journey much more efficient and enjoyable.
Yeah, I think that's a really great analogy, and thanks for reminding me of my age. And I think probably the last time I went to a looking at Gregory's or a Melways was at least 5 years, if not 10 years ago. And thank God, because I often got it upside down and the wrong way. Wade, let's now move along to look at the first case study itself, and I like to call this one compare the pair. So in this example, what we put to Milliman was a scenario where over a 10-year period, client A invests $100,000 into an Australian equity managed portfolio on the HUB platform, and we'll call that platform X. 5 years later, 2015, their advisor recommends to switch to another Australian equity managed portfolio, so portfolio Y. And then 5 years later, switches again to portfolio Z. For comparison, the same scenario was then replicated, if you like, or implemented using the equivalent Australian equity managed fund as an alternative, and following the same sequence of switching between the funds over that 10-year period. So what we can see in figure 1 here is an illustration of the overlap of the common assets or holdings between managed portfolio X, Y, and Z. And so the overlap ranges anywhere from 16 to 46%. So Wade, could you step us through, I guess, the findings in relation to the research and the results around this?
Yeah, sure thing, Brett. So, so I think it's a really good example of as I sort of said, initially around that kind of personalized journey, if you want to think about that, because inevitably, as far as a managed fund goes, when I want to transact and move from one portfolio to another, typically you sell down that entire fund, and every investor, it has to be done to maintain equity effectively across investors. Now in managed accounts, as you pointed out, we're able to isolate and identify the stocks that are commonly held, and effectively we don't have to necessarily sell them. And by doing that, you're avoiding transaction costs. You're in much better control of the overall taxation position. And so as we analyse the difference between selling each managed fund down or portfolio as we make those changes in 5-yearly increments versus continuing to hold and manage common stocks. And as you pointed out, this particular example, if you take Australian equities as an example, then actually across the universe of Aussie equities portfolios, there's a lot of commonality that takes place just given the size of and the concentration of the market. So what you can see here is over that sort of 10-year window, if we kind of operated down that managed fund line, then we sort of end up with 213,000 in a 47 tax rate environment, so kind of typical kind of ordinary investor. If we're doing it within superannuation, then the tax rate is obviously lower, so they get a bit more money. They get $242,000. But if we're able to kind of manage that common stock element, then you actually get a substantial bump. And because we're looking at after tax returns, then the tax rate will have a fairly significant effect. So obviously the benefit is higher for the higher tax rate payer. So what you're seeing there is you're seeing a $20,000 difference. So $234,000 almost versus 213 for that 47% tax rate investor, or almost $50,000 versus $242,000 for someone that's within superannuation, for example. So, and the way I like to think about that is actually, if you want to kind of consider the impact, then it's, in the first case, it's $20,000, but relative to the amount that it was originally invested, which is $100,000, it's actually an additional 20% over the initial investment amount. So it's quite a substantial saving when you think about it relative to what the investor originally put in to their portfolio, and likewise even in superannuation. you're talking about an additional, between $7,000 and $8,000, which is, just shy of 10% relative to the original investment.
Yeah, that's quite a bit for doing exactly the same thing under a different structure, isn't it? So I see that as probably the first thing. And then second thing is, over the lifetime of an investment, like this is 10 years. If you're taking a 20-year, 25-year, that difference just will broaden out further, and there's a compounding effect of money working for you while you're in there.
Yeah, and it's worth pointing out, I think, as we sort of did at the outset, this example here, you're seeing, two sort of significant portfolio shifts, but they're 5 years apart. So for a lot of advisors and their clients out there, they may have clients that are much more active than that. So if someone's, shifting their portfolio around every 2 to 3 years, then just that act of moving money more frequently than the example we've used here is going to increase the nature of that benefit or change it quite dramatically.
Yeah, that's a great point. And as we were talking about earlier, that with COVID volatility, we've probably been seeing a lot of switching occurring. So let's now move on to the second component, which is around the importance of tax optimization. So when you combine investment performance and tax minimization, I guess you end up with twin aspects of a client's overall result, and that can make a big difference to outcomes in managing someone's wealth over time. So what we have here is 2 case studies that were examined to quantify that value using tax optimization available on the HUB24 platform. So let's have a look at both of these. The first one is around a partial sale of a managed portfolio, and the second one is taking that sale and making it a switch instead. So in both of these cases, and let's start with case 1, the sell down or part sell down. What we did was provided real live data of an actual client on the HUB24 Invest managed portfolio, and gave that information obviously to Milliman to analyse. So in this case, the client opened an account with HUB24 in February 2017. They invested $536,000 into an Australian equity managed portfolio on the HUB investment platform menu. Part of that initial $536,000 was around 20% or 20% of the portfolio, about $110,000 that was in specie transferred. The client had held 5 individual stocks, as named there, some of them for 5 years, some for, I think it was 10 years, but only representing 1/5 of the portfolio. So just over 3 years, the portfolio manager rebalanced a few times and obviously had to deal with some minor corporate actions that they had to action over that time period. In this case, we also selected a manager that had low portfolio turnover at 20% per annum. Now, what we've been able to do in looking at our platform data and information is on average in the Australian equity managed portfolio options, that turnover has been about 35% on average. And at the upper end, you've got some managers at about 50%. So we purposely chose a low turnover portfolio manager. So on 31st of May this year, 2020, the account balance had grown by $102,000 to $638,084. And on the 1st of June, a sale of $320,000 was made for personal reasons. So they wanted to withdraw that, so roughly about half of the portfolio exiting. So Wade, can you step us through again, I guess, the workings behind this and the outcomes?
Yeah, sure. So this is, a really good example of what happens, and the flexibility you introduce now that every investor has sort of that beneficial ownership in place. As kind of pointed out at the outset, within that kind of managed fund environment, everyone sort of, owns the same thing, so to speak. Whereas now what happens is as these transactions have taken place, effectively for every stock that is held in the investor portfolio, we have the date that it was acquired, we have the tax position that sits alongside that stock from the purchase date to the current date. And so what we were able to do is by looking through every bundle of stocks that was purchased and accumulated and looking at their individual tax positions, we're able to compare two algorithms in this sense. We looked at sort of a traditional approach where effectively whatever you acquire first is the first thing that gets sold. So that's a kind of classic kind of FIFO approach, first in, first out. We compare that versus a position which looks at what we refer to as minimum gain. So really disposing of assets where the tax position is at the minimum amount, and I think as you'll point out, Brett, HUB has a number of other algorithms that are possible here, but we think those two gave us sort of the widest range of outcomes that we could compare just to show potential tax benefits. Advisors and their clients obviously may choose different algorithms based on the particular circumstances that they're facing. And then we looked at how that played out across different tax environments. So what you see here is if we're investing as a company and we're sort of subject to 26% and kind of just focusing on that bottom column, you'll also see we've looked at personal investors at a 47% marginal rate and also self-managed super funds. So the interesting thing is irrespective of the tax rate, the absolute numbers change. But what you'll notice is if you compare that bottom table, look at the FIFO tax payable versus the min gain tax payable, you're looking at 14,000 versus 7,000, 12 versus 6, 5 versus 3. And so roughly proportionately, regardless of the tax rate, you're paying just about half the amount of tax under that min gain algorithm than you would have paid under sort of an indiscriminate FIFO basis. And then interestingly, the last column there sort of converts that and turns it into an annual figure in terms of return for the portfolio. But like I just said, the thing that I find much more important, and certainly just from my own personal perspective, is if I'm sitting with an advisor and saying, well, look, I can actually help you pay half the tax you would have paid under the more traditional structure, then that's a real huge amount of value that's added to me as a private investor straight away. And whilst it might be 1%, which is nothing to balk at from a portfolio return over time, it's a very, very substantial change from a tax amount, which as I said, is immediate value that an advisor is giving to their client just by being able to use a more sophisticated approach to the way they invest.
Yeah, it does actually prove the value that can be done for an advised client versus a not advised client, I guess, at the end of the day. And this the 1% was done or effectively over a 3 and a bit year period. So again, over a much longer time frame, you could expect a bit more of a difference. But like you said, it's halving. In this case, it's halving the tax for the client, which is quite significant, and allowing, I guess, the portfolio to then compound on a larger dollar figure because you're not handing as much across to the tax department. So I think that's a really great example. So in moving to the second case study, the second example, we asked you to model exactly the same scenario, same client, same portfolio, same time frame, in specie transfer, etc., same growth. And this time, rather than redeeming $320,000, we wanted you to model if the client had switched that into another Aussie equity managed portfolio. And the outcome of that, the portfolio that was chosen had approximately 40% of their portfolio in the same stock. Having BHP and NAB and all the typical stocks that you'd see in an Aussie equity portfolio. So again, Wade, can I ask you to step us through this particular example of the switch?
Yeah, totally. So this again is a very interesting one. So as you just pointed out, and we kind of talked about this in the very first case study when we were looking at managed funds versus managed accounts, and that kind of ability to not have to transact stocks just because I'm moving portfolios when there's a lot of commonality and we kind of hold a lot of the same kind of assets in between different portfolios. So here, as we looked at the switch, the real kind of thing that stands out by being able to effectively, retain and hold on to sort of common stock is now, if you think about that first case study where we're talking about halving the tax, is what we've actually done or what the platform has done, and we've effectively analysed it, is they've turned a halving of the tax into a complete reversal of the tax position. So rather than have a gain you have to deal with, so in this case it was $5,000 on that company tax rate, is now they've got a carry forward loss of $1,900, and similarly on both the personal investor rate and the SMSF rate, we've effectively completely reversed it. So now the conversation isn't about halving the tax from an investor point of view. It's actually, I've now given you a carry forward loss that you can benefit from rather than having a tax liability. So again, just shows how dramatic some of the impact can be and how it can change the nature of the client conversation for an advisor when they're going through what historically would be viewed to be a purely administrative task in terms of how you move money from one portfolio to the next. Is now you're creating genuine value, as you kind of refer to it, platform alpha for advisors that they can communicate to their clients, which is quite powerful.
Yeah, and I think the examples of the personal tax rate at 47% is probably fairly typical, but also someone who has a self-managed super fund, because often you come across the argument, it doesn't matter so much in super, but it still does. It still makes a difference. I guess the other thing to point out with all of this is that HUB, through built-in functionality and those algorithms, are all built for advisors, so they don't have to go and select out the individual parcels. It's just the hit of a button to either choose the FIFO method, the minimum gain method, or another method which is maximum gain. So if you wanted to trigger as much capital gain in a particular year, and it might be because the client has other tax losses to offset, you can choose that. This is all about flexibility and the ability to tailor to individual client circumstances, which is the important thing. So Wade, we might now move across to the third component or series, which is around progressive portfolio implementation. And I guess that was the third sort of pillar that we sort of spoke about. And really what it's about is handing to portfolio or asset managers additional tools that they can use to create greater flexibility around managing more complex investment situations and challenges that occur when managing portfolios. So PPI, if I can call it that, allows the portfolio manager to manage and adjust portfolios to both market and economic conditions, but also tailor specific solutions for new invested funds compared to the existing invested funds. And I call it something akin to sort of running a parallel or multiple sort of portfolios with the aim to add additional performance and to take into consideration things like client costs and also capital gains tax implications. So, Wade, can I just ask, in your view, how important is it for portfolio managers to have a strong platform and tools and the type of technology that we're talking about at their disposal, like platforms like HUB24, to help them solve the more complex issues and enable them to get a better result?
Yeah, absolutely. Obviously, it's vitally important. I think, and as I sort of mentioned at the outset, where clients and advisors are facing this sort of low return environment, the same thing can be said for portfolio managers. So, we're seeing this effectively across the entire value chain, where everyone is looking to eke out some additional value to try and get that little bit of extra return. And I think it's one of the areas where technology is really stepping in, because the traditional models that we had in the past would mean you'd be kind of effectively forced into decisions that you may not entirely want. And so, we'll go through the case studies in a bit more detail. But really what you're able to do now as a portfolio manager is you're able to sort of act on things earlier to the benefit of new investors, for instance, but still retain the value that you kind of see emerging from the way some of your current investors might be positioned. And so you're kind of just giving a wider range of options. You're giving this sort of grey scale in between, what would have typically have been these binary decisions where I either keep everyone invested one particular way or I switch them all to a completely different approach. Whereas now we can transition more seamlessly between those two extremes to the benefit of everybody.
Great. So, Wade, in the research paper that we've just released, we actually modelled 3 examples around PPI, but in the time that we've got, we're probably only going to cover 2. So the first one is around funds that go through a hard close. So I'll get to that in a minute. The second one is around the issue of shares reaching a target price. The third that we won't go into today is based around dealing with stock within a 45-day window in terms of the dividend, and therefore if new investments are going in at that point in time, they're not qualifying for that dividend, but the price drops post-dividend. And so that causes a dilemma for the fund manager, or all these 3 examples do. But we'll just cover off 2, and for those who want to see a bit more, get hold of the white paper. So in this example, and I've seen this happen many years of being in this industry for decades, hard closed funds cause quite a few problems. And so hard closed funds typically happen with small cap Aussie managers, micro cap funds as well, where the success of the fund draws money in to a point in which it gets to capacity, and the manager needs to close that fund to maintain the performance for existing unit holders. Now that causes an issue in terms of you trying to keep a model portfolio or a managed portfolio consistent. So you've got to decide to sell out of that, or how do you keep it and where do you put new money? And so in this example, we have $100,000 micro-cap fund on the HUB24 platform on the 27th of May 2015. That micro-cap fund grows to 130,800 and then closes on the 31st of October for new money in 2019. So the dilemma, does the portfolio manager sell the existing fund and reinvest in an open alternative fund, or is there something else they need to do? So Wayne, can you step us through your findings and your outcomes on this?
Yeah, so as you kind of pointed out, what we're able to do here, because of the way that PPI approach operates, is the portfolio manager is able to kind of retain existing investors and the funds that have been accumulated in that hard close fund. And then as new money, incrementally comes into the portfolio, they can reallocate that out into new investments of their choice. So, what we're effectively able to do is look at the way the portfolio has increased by being able to continue to operate in that way, but also assess the amount of tax that has been saved, because if that PPI approach wasn't available, effectively all assets in that hard close fund would have had to been sold down and then reinvested into the alternative. And so again, different tax rates here, a 47% rate and a 15% rate. But what you can see is relative to that $100,000 that was invested, by avoiding not having to sell everything down, you've effectively saved $7,000, just shy of $7,500 at the higher tax rate, or $2,500 for someone at 15%. So again, not an insignificant amount of money, given that the portfolio value itself is increased by $30,000. You're able to kind of get an additional, what is it, like 25% almost at that 47% tax rate by not having to sell down the assets at that point in time.
Okay. That's a good example. So let's move to the second example. So in this case, this is about share prices reaching a target value for the portfolio manager. So in this case, we put to you a global equity managed portfolio, equally weighted to 25 stocks in the MSCI World Index. 5 of those stocks were tech stocks, like Alphabet, Google, Microsoft, etc. And they represented 20% of the total portfolio. So in this case, the portfolio manager, their opinion was that the 5 tech stocks had reached their target price in September of 2018, but not to the point in which they were wanting to sell it, but they didn't want to put any new further monies in at that peak price. So instead, the portfolio manager allocates the new investments into the S&P 500 into an ETF, rather than continuing to invest in those particular stocks. So again, can you step us through the outcomes or the thinking sort of behind this?
Yeah, so again, in a sense, somewhat similar, but they're now focused on this price target. So as you sort of pointed out, this is just given the manager that kind of ability to transition the way that they're looking at how their clients are invested, and clearly there becomes this sort of interesting point where as share prices run up, you begin reconsidering whether you continue to invest in them. And in this case, what they're able to do is they're able to sort of maximize the value that existing investors get from their projection of where that share price will go, but they're able to redirect new investors into alternatives where they think there's kind of a better position for them given the timing of when they're coming into the portfolio. So what you can see here is you follow that kind of light blue line where it starts off and you've got that PPI track running in terms of portfolio value. Then all of a sudden it gets to the point where they believe the price is close to or near that peak. So then you start to see, as we've modeled it out, that divergence between where say those new investors are being transitioned in a sense, and if they weren't running PPI, then effectively everyone would get sold out and then put into something else, or you continue to effectively sort of eke out less returns for the new investors. And so what you can see is by the end of this, and it's not a particularly long time horizon, we're talking about 6 months from the very start of this chart to the end, and probably 3 or 4 months over which the PPI has taken effect. So for that $100,000 initial investment, the point where they believe the price has reached that point close to the peak, you're now seeing not quite a $5,000 divergence there. So again, that PPI impact is actually quite significant given the time frames and the amount of money we're looking at.
Yeah, and I guess, Wade, that's taking an example of going into an ETF So you're still getting exposure to the market, but not the tech stock area. Because the manager could also choose to invest that elsewhere. They could put it in cash, for example.
Yeah, absolutely. Like I think, what we've done here is taken a very much a view of looking at like for like type investments, so to speak. But the interesting thing and the real sort of flexibility this gives portfolio managers is, I guess, the divergence in their views and how they implement it could be very, very simple like this, where they simply look at it and say, well, we just want to replace these particular stocks with something that's much more of a broad-based market index. But they could potentially also use it for larger tactical decisions, where they might phase in, they think, well, markets just generally are becoming overvalued. Do we start, transitioning people from, growth exposure to something that's more defensive or cash oriented, as you pointed out? So the flexibility in the options here are quite dramatic when you start thinking about it in those terms.
Yeah, I guess they could also just be waiting for a correction in share prices to start moving back in. Yeah. So it could just be a temporary scenario of management. That's great. So I guess to summarise and in conclusion, we've presented 3 themes and 5 case studies to try and help you quantify how great advice with smart and I guess sophisticated platform administration can come together to add value for clients. So while a lot of platforms may look similar and they're much of a muchness, they're certainly not. And when you look under the hood, so to speak, you can see a number of differences. So with greater focus on best interest duty and a genuine desire to deliver best outcomes for clients, advanced technology platforms and the choice around that is crucial. So just looking at these 3 points, managed portfolios versus managed funds, we had a look at that with potential benefits provided, contrasting the 2 different structures. So it's largely about the ability to manage capital gains tax when switching, and it's also about minimising, the cost when rebalancing. Tax optimisation, using the tools available to select from 3 different tax method outcomes with an algorithm behind it. So the platform will then go and select the best optimal parcels to use. And then thirdly, for the asset managers, giving them, excuse me, the tools around smarter ways in which they can adapt to particular scenarios, taking into consideration the market, and also looking at, I guess, quarantining off parts of that portfolio where capital gains tax might apply for sales. So effectively running a dual lane freeway, if you like, is another way to think about it. I guess the research has provided anticipated evidence. It's been hard to quantify this over the years, but that managed portfolio structures, tax optimization, and smart technology can add what we call platform alpha. Wade, I'd really like to thank you for joining us here today and taking us through all of this. Appreciate your time and the work that Milliman behind the scenes have done with us in quantifying platform alpha. So thank you.
No problem, Brad.
I'd also like to thank everyone who is attending this. Thank you for investing your time in this webinar. Hope you found it both enlightening and also valuable. CBD points are available, and also the Platform Alpha research paper that we've been talking about is now also available for you to download whenever you wish. So thank you again. If you need to reach out, please contact your HUB24 BDM, or if you'd like to email marketing@hub24.com.au if you've got questions to Hub, myself, or Wade. We're here to help you, and on behalf of all of us here at HUB24, stay well and stay safe, and thank you.